Hey, welcome back. I'm on my way home and the sun's still out. Days are getting longer. It's 5:30 here and it's still light outside. I am totally here for that. Can't wait until spring hits. It's just around the corner. I can almost taste it, but that's not why you're here. So let's jump into what you are here to talk about. And today we're talking about the Federal Reserve and their meeting today on the 26th of January. What I want to do is I want to kind of pick through what they said and, more importantly, what they didn't say. I'm going to go over why it's important and then just what we can do as individuals, because the Federal Reserve and what they do has very little impact on our day-to-day activities. But long-term could have some serious effects, which is what you and I, as people who are interested in building wealth, need to pay attention to. So let's actually start with why it's important. I just touched on this a little bit, that what the Federal Reserve does, what the government does, has very little impact on what I do, what the average human does on a day-to-day basis. No matter what they said today, I was still going to get up and go to work tomorrow. I'm still going to pay my mortgage every month. I'm still going to feed my kids every day. So it didn't really matter what they said as far as my activities. But as far as building wealth goes, it might impact where I decide to put my money. It might impact how soon I want to spend my money and where I'm keeping it until I want to spend it. We'll dive in a little bit more on what that means. So what did they say? Basically, the Federal Reserve came out today and said absolutely nothing has changed. I think actually what is more important to note is what they didn't say. First, let's go over what they did say. What they did say is that interest rates are not rising right now. They said that they're still printing money. And I think it's important to know that raising interest rates and printing money are two sides. They do opposite things in the economy. So if you raise interest rates while you're printing money, it evens out, more or less. That's an oversimplification, but that's what you need to know. And in fact, I don't really understand to the fullest extent the whole situation of that, but that's what you need to know. So interest rates are staying the same. The Federal Reserve is still printing money. Inflation is still high, but jobs look really good, even though there's a labor shortage. That's what they said. But what's more important is, and pay attention here, is what they didn't say. Well, what didn't they say? What they didn't say was when interest rates will raise, because everybody that I follow that knows anything about the economy has predicted that interest rates will raise. In fact, they're pretty much at zero now, so it's only logical to expect the only place they have to go is up, right? Especially because that's one of the ways you fight inflation, and inflation is really high. What they didn't say is how much it would go up. So we don't know if it will go up in the next meeting. We don't know if it will go up a lot. We don't know if it will go up a little. And that affects how people borrow money. Interest rates from the Federal Reserve affect mortgage rates. So any new loans are going to be more expensive. And what I mean is, today you could buy a house for $200,000 if you live somewhere where houses are available for $200,000 and have, a certain payment. Well, if they raise interest rates, then your payment is going to go up for that same $200,000 home. So that affects people's cash flow. What they didn't say was how much inflation is. They said that we had exceeded the target. We were well over their target of 2% of inflation. But they didn't say how much it was. And when confronted, they did admit that it was much higher than they had expected it to become, and lasted a lot longer than they have expected it to last. So all of those are things they just kind of danced around. And what it amounts to is this mentality of hurry up and wait. So what are they doing, basically? And they're taking a very conservative approach. And I'm not knocking them for that. I might do the same thing if I was in their shoes. What they're saying is that things are very volatile right now. Don't we all know it? We don't know what's happening with the pandemic. It goes up, it goes down. We're excited to get, things back, and then a new variant shows up and people are back down for a while. Industries are booming and then they're not booming. We can travel, we can't travel. There's a lot of uncertainty. But what happens when there's uncertainty is that people panic, right? People don't know what's going to happen, so they don't feel secure. They want to hang on to the cash that they have, to the assets that they have. And if you've read your history books or paid attention in history class at all, you know that panic is what started the Great Depression. So it's not surprising to me that the Federal Reserve is taking things very slowly. They haven't yet tapered off their printing money, but they plan to by March. That's another 2 months, right? They haven't yet raised interest rates, but we expect them to either in the next meeting in March or the following one in May. They haven't yet done anything to combat inflation, but we expect them to. What they were sure to say was that things are unprecedented. Situations are unprecedented. And things, as they progress, the Federal Reserve will be prepared to act quickly. That just tells me there's more uncertainty, because if they're right now taking things very slowly, then to automatically and abruptly change like that would bring even more uncertainty. It tells people that they can't rely on what the Federal Reserve has been saying for a very long time now. That, we will see slow rate increases. We will see slow tapering so that the economy doesn't change too quickly and crash. And that emotional aspect behind how people react to the Federal Reserve's words is almost, and I think it is, more important than what the Federal Reserve does. Because the market's not guided by what they do as much as what you and I, as individual people and investors, do. So that's a rundown of basically what they said and what they didn't say. And now, what does this mean for you and me, the individual person, the individual who's interested in building wealth, the individual who's getting started in building wealth, the individual who wants to one day build wealth but hasn't started yet? What can we do? What is this a good time for? And I have to preclude this by saying I'm not a financial advisor. I do not have any sort of financial degree. So this is just my own thoughts, my own opinions right here. What's really interesting to me is that on another YouTuber show, Graham Stevenson, I saw that a content creator, not him, but another content creator had worked up 3 scenarios of investing in the stock market. One where a person bought at all the worst times when the prices were really high. One where a person bought at all the best times when the prices were really low. And one where the person just consistently invested over and over and over again without regard to what the market was doing. And interestingly enough, the person who invests consistently without regard to what the market's doing ends up with the most amount of money. Kind of funny, huh? So that's one thing you could do. Now, I have to say also that I recommend, and this is what I do, is investing in what you know. I don't know a lot about the stock market, so I don't put a lot of money in the stock market. In fact, I'm running a little experiment right now where I have 1 Acorns account. It's the only money I have in the stock market. And I've been investing $5 a week for the last 10 weeks. Obviously, this experiment's going to go on a lot longer than 10 weeks, but this is what's happened so far. For the last 10 weeks, I've invested $50 in total. Today, my investment account is worth $48. Just about. So all in all, I've lost $2 of my money, which is like 4%. 4% is a lot when you think about the fact that if I rented my house out and got 4% return on investment, I'd be kind of rolling in some cash right now. 4% in the world of finance is quite a lot. When you think that the stock market, on average, they brag that the trend is the stock market grows an average of 10%. I think that's a huge loss. But like I said, it's just a small experiment. We're going to see what happens over time. What else can you do? Well, you can keep an eye on things. If you are into real estate, if you have a home and you got a home a while ago and your interest rate is high, now might be a good time to refinance. You obviously have to check out your own personal situation and see if that's the best thing for your situation, but now is a great time to lock in a low interest rate. Like I said before, interest rates are near zero and they are likely only to move up from there. When you're investing and when you're thinking about spending money, think about inflation, because inflation means that your dollar is worth less. So if your money is in dollars instead of, say, purchasing a house that goes up in value, the value of your dollar is going down right now. So if you're really risk averse, maybe this is not good advice for you, but if you are someone who is interested in buying assets, interested in building wealth through asset purchases, now might be a good time to do that. Because when the Federal Reserve talks about inflation right now, they not only said it is higher than expected, but they said that all of their sources predict that inflation will go down. I don't predict that inflation will go down. And here's why. The Federal Reserve is supposed to be a catalyst for what's happening in the economy, and they're not doing anything right now. I know it's the beginning of the year, but if this trend continues, they didn't do much of anything in December, they didn't do anything in January, they probably won't do much of anything in March. They have indicated that they expect a slow taper and they expect slow interest rates to slowly rise. So if they're doing things slow, change is not going to happen quickly. Inflation's not going to go away quickly. Supply chain issues aren't just going to magically disappear. I predict that none of that is going to happen in this year, maybe not even next year. I think we're going to be feeling these effects until 2024 and 2025 at least. And we'll see if that comes to pass. But if they're not doing anything to change things, they're just waiting and hoping that other factors are going to better the economy at a quicker rate. I don't think it's going to happen. So if inflation is still high, if inflation is going to stay high for the next year or two, you're better off putting your money in something that will go up in value, or that you believe will go up in value at a higher rate than the dollar will. So that's basically it. Like I said, I'm not super knowledgeable about the topic, but if you found this helpful at all, please give it a thumbs up so that other newbies like you and me can benefit from the layman's terms what's happening in the economical world, and that, you know, this algorithm can just send this to other people throughout that are interested in hearing what the Federal Reserve had to say. Anyway, that's all for today. I will see you next time. Leave me a comment down below if you agree with me on what is happening and you think my predictions are true, or give me your predictions for what's going to happen, because I don't know everything and I'd love to hear your thoughts. I will see you in the next one. Bye.